Good afternoon, everyone, and welcome to today's webinar hosted by the Federation of Credit and Financial Professionals and our data partner, Credit2B. I'm Justin Warden, the Marketing Coordinator for Credit2B, and I'm here today with Ken Frisco, the Operating Board Director of the Federation of Credit, and our presenter, Joseph DeFalco, the Senior Manager at EisnerAmper. Joseph will be presenting today on revenue recognition and what has changed over the last year, since EisnerAmper did a presentation on revenue recognition for us about a year ago. A few items to get out of the way before we begin. If you do have any questions throughout the course of the webinar, you can feel free to use the questions function in your side panel. We'll take all those questions and organize them for a Q&A at the end of the webinar. We also have a copy of the presentation slides available for you today. They're also in your side panel under the handouts section. You're able to download those and follow along as Joseph goes along in his presentation. We will also be sending a copy of those presentation slides to everyone after the webinar is complete. The last thing that I wanted to go over before we begin is we will have a brief survey that comes out as you exit the webinar. It only takes about 30 seconds to fill out, but it gives us a lot of great insight into how we can continue to make our webinars better for you. So with that, I'm going to pass it over to Ken and let him introduce our speaker.
Thank you, Justin. Okay, just a little bit background on Joe DeFalco. He's the Senior Manager at EisnerAmper, and he provides accounting, auditing, and business consulting services to clients in the public and private sectors in a variety of industries, including technology, life sciences, manufacturing, and professional services. As a member of the firm's technology and life sciences groups, Joe helps clients navigate the complex accounting challenges that industries can face. He is also active in the firm's public companies group. Joe graduated magna cum laude from Kent State University with a Bachelor of Science in Accounting and is an active member of the New Jersey Society of Certified Public Accountants, and he's also a member of the American Institute of Certified Public Accountants. So I'll pass the mic over to Joe to start the presentation.
Thanks, Ken. And, thanks for having us today for your webinar. We certainly appreciate that. And you know, the purpose today is just to give you a little bit of update where Mark Sabatis, my colleague, last year left off. You know, 2014, there was certainly a significant ASU that was issued by FASB dealing with revenue recognition. And, you know, this year there were a couple of movements to make some modifications. So certainly a timely topic and continues to change. So it's always good to get a little bit of update on the subject. So let's start out with just kind of a little illustration of, you know, what Mark probably discussed with you last year, and just kind of a high-level concept of what the original standard that was issued in 2014 really dealt with. So what you have is you start out with a seller. You got somebody who's looking to sell you something. He's got goods, services, maybe a warranty, training, you know, all sorts of items that he's going to sell to your buyer here, right? So now, what does the buyer have? He has money. He's going to pay for his goods, services, and warranty training. And once you have these elements, you've established that you have a contract or an agreement under the guidance. So now what the buyer and the seller, really more the seller from a revenue recognition perspective, needs to do is figure out, okay, how much of that contract price relates to the goods in that contract, the services, and the warranty and training. So seller needs to go through a process of allocating what consideration needs to go to each of those deliverables under the contract. So from there, buyer gives money to the seller gives goods to buyer, services paid for, seller delivers, warranty and training might be provided by the seller, and then the buyer pays for it. Just a high-level illustration of, you know, this next slide, which is really the 5 steps under that that 2014 standard that really walk the companies through how revenue needs to be recognized under this new model. So first, identifying the contracts with the customers. This is one of those things where a little bit of consideration needs to be given to not just a contract in hand, but also consider all arrangements with a particular buyer and, customary practices your business. One of the things that the standard, forces you to do is take a look at all arrangements. And if there are in substance, really one arrangement that's in form, diced up into multiple contracts, the guidance tells you to look at it all as one agreement, not necessarily to look at it as separate agreements. So the next step is to identify the separate performance obligations in the contract. What this really requires you to do is take a look at what you're actually doing for that buyer. And if there are, like in our example, separate goods and services that are considered distinct, they may have separate accounting requirements. And they say distinct means it's either sold separately or could be sold separately. So in other words, you can dice this stuff up, and on a standalone basis, you could actually provide that service or sell that good to that buyer. And then, of course, determining the transaction price. The one thing that we'll talk about in a little bit on a recent development, I'll just point out here, the original guidance said that a collectability must be probable. So you had to go through a determination up front and, get a level of comfort that whatever your consideration was, that contract price was deemed collectible. So there's a little bit of a modification to that in 2015 we'll talk about. And like we mentioned in our example there, allocating the transaction price to the separate performance obligation. So that was the seller's goods, his warranty, his training, etc. This is really straightforward, just taking that consideration and figuring out what each of those items would sell for on a standalone basis and allocate the transaction price to those elements based on what their standalone price could be. If the selling prices were unknown, let's say, you could estimate under this guidance. And then recognize revenue as performance obligations are satisfied. So as you deliver, you're recognizing revenue. And if you have multiple obligations under the contract, you're going to be recognizing those obligations as you perform them, as you deliver to your customer. So the amendments. So really at a high level, the FASB issued 4 things during 2015. One was an actual accounting standard update, which amends the guidance that they issued in 2014. The other 3 are proposed exposure drafts on potential modifications. So they were issued, I'd say May, July, and September. So they're in various stages of comment periods and wrapping up. So the important thing to remember is that this one that we're looking at here, ASU 2015-14, is the only one that was actually approved. The other ones are still in the process of being vetted, and the best guess probably for adoption, we're here now in the middle of November, so I would say you'd probably look for activity in the first half of 2016. Unlikely that much is going to get pushed through before we get to the end of the year. So the big thing with 2015-14, it's pretty simple. It just extended the adoption requirements 1 year. So it pushed out the required adoption 1 year for that standard that we just talked about, the one that was pushed out in 2014. So originally, public companies needed to adopt this during their fiscal years that began after December 15th, 2016, just pushed out 1 year. Private entities required adoption was fiscal years beginning after December 15th, 2017. Now it's after 2018. So essentially January 1, 2019 for calendar year companies. The only nuance here is in the provisions related to early adoption. Originally, public companies were not allowed to early adopt, and private companies could early adopt by following the requirements of the public companies, so December 15th, fiscal years beginning after 2016. Now, both private companies and public companies can elect to use the additional adoption or the original adoption period. So public companies can still, if they were on target to adopt for their, let's say, a calendar year public company, they could still adopt January 1, 2017. And private companies have the option to adopt as early as January 1, 2017 as well for a calendar year company. So now that's the only thing that's really changed in concrete. Like I mentioned, the next 3 items are really proposals that were put out in various times of the year, and they're still, you know, being thought through and have not been adopted as the new guidance yet. So we'll go through these, and you know, the thing to keep in mind is anytime a significant standard like this is going to be introduced, this is a major change in the way, you know, we look at accounting for revenue under U.S. GAAP. So anytime there's a significant change, the stakeholders that are involved, the preparers, the users, are going to have a tremendous amount of feedback. So that was pushed out in 2014, the change. Feedback rolls in. Now here come the clarifications and the amendments to try to make it more user-friendly and easier to understand. Thanks. So in 2015, the first proposal was issued to amend certain aspects, specifically on identifying performance obligations and accounting for licenses and intellectual property. As I mentioned, this is just really a result of feedback and discussions with the Transition Resource Group, which was established to try to help facilitate the transition from the old way of doing it to the new way of doing it. So when we talk about performance obligations, there were a couple of areas that were concerning and confusing to the stakeholders. So those areas under the 2014 guidance, determining whether promised goods and services are separately identifiable, that is, distinct within the context of the contract. So there's really 2 questions, right? Can the customer benefit from individual items embedded in a contract on their own or with readily available resources? And is the seller's promise to transfer the item separately identifiable from other promises in the contract? So a lot of people were struggling with, all right, every contract that I have with a customer, how deep do I have to drill down and identify how many different obligations I have in that contract? In some instances, you could find, you know, a number of obligations in a contract, anywhere from you know, not just delivering the product, the shipping related to it, the obligation to warrant that product for a year, whatever the case may be. So what the FASB went and did when they issued this this clarification, they really want you as the seller to identify what was the real intent. Were you delivering, transferring individual goods and services to a customer, or was the intent to transfer a combined item to which goods and services are actually just inputs? So, you know, a good example is maybe in my business, what I do. I do audits for publicly traded companies and private companies. So I get engaged by companies to deliver ultimately an audit opinion. It's my opinion on the company's financial statements, right? But as part of that process, I'm engaged, and part of my professional responsibilities require me to plan the audit, to perform field work, to do wrap-up, and everything leading up to the issuance of the one piece of paper that says the financial statements are materially correct, which is what everybody looks to. So essentially what this clarification is saying is that all of those items that I discussed in my process are really just inputs into getting to that one deliverable, which is ultimately my opinion. So I would not, as an accounting firm, need to recognize revenue or determine what actual consideration needs to be allocated to my planning, to my field work, to my wrap-up. It's really, at the end of the day, all related to the one deliverable, the report. The other important thing in that clarification was if there's immaterial deliverables in the contract to the contract as a whole, they don't need to be considered, so you can just essentially ignore them. The other piece of this update specifically dealt with some concerns and confusion around revenue recognition for licenses and intellectual property. Essentially what it does is it amends the licensing guidance and categorizes all licenses into two categories to determine whether revenue is recognized at a point in time or over time. So the two categories end up being functional and symbolic. So functional is a license that has a significant standalone functionality. So a great example of a license is a license to use software. Let's say I have a license to use software for a period of 10 years. Once I enter into that license and I have access to that software, I have the ability to use it. I have the functionality of that software on day one. And I can use it as much as I want, day one, day two. I might even stop using it in year 3, even though I have the ability to use it up to 10 years. What this is saying is that since I have this significant standalone functionality up front, the person who sold me that software can actually recognize the revenue for that license up front as opposed to the period of the license. So that's an example of what would be considered functional. Symbolic is really licenses that deal with everything else. So something that doesn't necessarily have that standalone functionality on day one. A couple of common examples would be trade names, logos, franchise rights, those types of things that we would truly think of as intangible assets on a company's books, and you can't really grasp when you're getting benefit or the actual functionality from those items. So those would be recognized more likely than not over the period of the license term. Some other matters that were discussed in this update: determining whether shipping and handling activities are a promised service in a contract or activities to fulfill an entity's other promises in the contract. So essentially what this clarification says is that if shipping occurs before the customer obtains control of what they're buying, then it's considered a separate performance obligation, and you would have to attribute some of that consideration to this performance obligation, and then you would recognize revenue for this performance obligation when you actually complete it, so when you actually ship. So if shipping occurs after the customer obtains control, then the entity can elect, they have to do it consistently, but can elect whether to account for the shipping as a separate performance obligation or not. So that's just a little bit of clarification there on one concern that stakeholders raised. So the next piece of proposed guidance came out, I'd say in the summer, probably July timeframe. Revenue with contracts, or from contracts with customers, principal versus agent consideration. So this is, of in itself, in the current accounting guidance that we live with right now, it's a pretty complicated area and involves a lot of consideration and also a lot of judgment. If anybody's ever dealt with considering whether somebody recognizes revenue gross as a principal versus net as an agent, the current guidance has essentially a list of indicators on both sides, and just kind of, you have to go through each one and consider whether it's relevant to your situation, and essentially there's no hard and fast answer to determining it. You have to look to the indicators and almost kind of build an argument as to why you're the principal in a transaction, essentially the person that the company views as the seller. versus the agent. And in current guidance, the agent could be kind of somebody that you have to fulfill something for your customer. So let's say, for example, you're Groupon, and you engage in, I don't know, let's say Titleist, right? And you want to offer these great discounts on golf balls, gross of golf balls. So you engage Titleist to do it. Essentially, your customers, Groupon's customers, see you as the service provider. However, you really don't have much to do with the transaction. You have some sort of negotiated arrangement with Titleist that says, I'm going to get 5% on every gross of golf balls you send, but I'm not going to take ownership of those golf balls. I'm just going to get orders in, and you're going to ship them out. That would be indicative of a net arrangement where Groupon's acting as the agent as opposed to the actual principal in the transaction. And I don't know if you all are familiar with the IPO that Groupon went through, but this was actually an issue with their IPO where they had to go back and restate revenue because they were recognizing revenue gross. If somebody was paying, let's say, $200 for that gross of golf balls, they were recognizing $200 as revenue instead of the 5%. So they had to go back, the SEC made them go back and restate. So going back 1 second, just on the proposed amendments to this principal versus agent guidance. So the FASB focused in on the actual unit of accounting for the principal versus agent assessment, how the indicators help an entity evaluate whether it controls a good or service before it's transferred, and how the control principle applies to services performed by another party, i.e. a subcontractor. So we'll take a look at these one at a time here. So the unit of account. So among the changes to clarify the principal versus agent assessment, FASB clarified that the assessment should be performed at the performance obligation level. So what does that mean? So you've got a contract with a customer where you've, back to our original drawing, you've agreed to sell goods, perform some services, and also warranty and provide training. So you've got, in that example, 3 or 4 performance obligations under one contract. So what this update is saying is that you need to go and perform the principal versus agent consideration on each individual performance obligation, not the contract as a whole. So you could have instances where you've got a contract where some of the revenue is recognized gross as the principal and some is recognized net as the agent. So it's a nuance that I'm sure not that many people are thrilled with because it's another step of analyzing and digging into each one of those contracts and evaluating each performance obligation separately. So the control aspect. So under this proposed guidance too, the FASB expanded the control discussion to cover instances where services are performed by another party. The amendments clarify that a principal can control a service even when another party actually performs the service if it can direct that party to perform that service on its behalf. So the threshold always used to be, under the old world, in the world that we're still living in since this isn't adopted, you always look to who's actually providing a service and who the customer looks at for fulfillment, right? So if somebody's doing something behind the scenes for me as a company, but my customer doesn't know about that person or thinks that I'm doing it, if something goes wrong and they're calling customer service, they're calling me as opposed to somebody who's doing that service. That was the old way of looking at it. Now what we're looking at is, can I control that individual who's actually performing those services for me? And if I can, then it's a pretty strong indicator that I'm going to be the principal in that transaction, not the agent. So I'd be recognizing revenue gross. So then the FASB, just kind of back to what I was originally talking about under the current guidance, where there's in the guidance there's a long list of indicators that you might be the principal in a transaction and a long list of indicators that you might be the agent. So now what the FASB is proposing to reframe that outlook there and just provide a list of when an entity is the principal. So if you're not hitting those items on the list, then you're the agent. There's no separate criteria for evaluation. So the next piece here, which is the latest and greatest, it was just pushed out in September, and it's actually still under comment period. I think it goes until next week or the week after, so they're still accepting comments on this. It's actually a pretty decent insight and some clarity into the original standard. So I think out of the three that we're talking about, this is probably one of the more helpful ones and clarifies some of the questions that people have been having and concerns. So I had alluded to it in the beginning that one of the things that was going to change is how we look at collectability and the threshold for recognition, how it's affected. So this touches on that. Also the recognition for non-cash consideration. The new standard had a threshold in there. If you had non-cash consideration, it needed to be recognized at the fair value. So we'll talk about that a little bit. The thing that it was neglecting was the fact that it didn't talk about when you actually calculate that non-cash consideration's fair value. Was it at the point of time, or was it at some point in the future when it's actually paid? Completed contracts at transition. The last two here are really just trying to help people as they get their heads around, all right, I've got this revenue that I've been recognizing historically with this one way. When I transition to this new way, what do I need to do? And these additional considerations, as Mark probably touched on it last year, there's a modified retrospective adoption approach where you have to take a look at any financial information that you're presenting comparative to your current period, and you have to consider what the impact of this guidance has on your historical numbers. You'd have to make adjustments accordingly. So the last two on this, completed contracts at transition and the addition of some other practical expedients, really deals with how do we transition from where we are today to where we're going. So collectability. So this was a big one that gave a little bit more clarity and insight into what this actually means, and actually loosens up the standard quite a bit with this interpretation. Enables an entity to consider whether they have the ability to cease providing goods or services to the customer in the event of non-payment. So what does that mean? So another good example is in my business, is providing services to clients. If we're going along, we're providing services, I might set up an engagement where I'm billing monthly on a 10-month engagement, and I can assess as I'm going along, if I'm not getting paid. I could certainly have discussions with my customers, try to expedite it, but I can get a sense as I'm performing my services whether or not I'm going to be able to continue, or at the end of the day, reserve the right to resign if I get the level of, or don't have a level of comfort that I'm going to get paid. That's kind of what this is talking about here. Enables an entity to consider whether they have the ability to cease providing goods or services in connection with an event of non-payment. So if at the end of the day an entity has the ability to say, hey, if you're not paying me, I haven't actually performed all the services, but if I get that sense and I have that control to almost pull back and stop, it adds a little bit of clarity, and it gets you over this threshold of not probable, and makes you look at it a different way. So the intent of this was to reduce the amount of contracts that entities will deem not probable of collection, where you can kind of say, hey, if I'm not going to get paid, I have the ability to stop. So up front, I have control, so I can treat this threshold as being met. I can stop providing services at any given time, and you overcome this not probable of collection criteria of the original guidance. So that's certainly one of the ones that was a huge sticking point with a lot of stakeholders. Non-cash consideration. So what this clarification specifies is that the measurement date for non-cash consideration is at contract inception, which, makes a lot of sense. A great example of this, or a good example, is I sell goods. My buyer, he doesn't like to pay cash. He likes to pay in gold bricks, and I let him pay in gold bricks over a period of 6 months. We negotiated a price of 1 gold brick per month for 6 months. So the question becomes, well, do I value that gold as he gives it to me? How do I recognize the revenue if the fluctuation in the price of gold is going to be changing over that 6 months? How much revenue do I recognize on this contract? So the answer is that you calculate what the fair value of that gold is for those 6 bricks at contract inception. Probably a more practical example is paying for services with a company stock. Of course, the value of the stock could be changing over a period of time that services are performed, and maybe the delivery of stock might be at the end. Probably practically, though, non-cash consideration is less of an issue for most companies. I think that's probably fair to say, but it could be an issue. And then ASU 2014-9 requires that cash consideration be measured at fair value, but it neglected to say what date. So the clarification is you measure it at contract inception. So it clears up that misunderstanding. So the next two are the discussion of some clarifications regarding transition to the new standard. So completed contracts at transition. The original standard provided entities with the ability to exclude completed contracts from the application of the standard. This proposal update clarifies what contracts meet the definition of complete. So what it says is that a completed contract is a contract for which all or substantially all of the revenue was recognized prior to the date of initial application of ASU 2014-9. So essentially what it says is that if you considered something complete and recognized prior to your required adoption of 2014-9, just let it lie where it lies. You don't need to assess it on how it would have been recognized under the new standards for that comparative financial statement that you're going to present. You just kind of let lying dogs lie, which is a good thing. It should streamline the process quite a bit of transition, which is expected to be egregious for some. Some practical expedients. Sales tax. So what this clarifies and allows individuals and companies to do is present all sales tax collected from customers on a net basis rather than evaluating them on a jurisdiction by jurisdiction basis to determine which amounts to exclude from revenue. Any tax such as use, sales tax that are collected on behalf of third parties. So essentially it's saying you recognize sales tax on a net basis. It really doesn't have any impact on your revenue or your expense. It's just it's a pass-through. Also, another practical expedient, if you have contracts that are modified multiple times before the adoption of ASU 2014-9, what it lets you do is it lets you take the hindsight approach for figuring out what the actual consideration of those contracts are. So if you have agreements that are modified multiple times, the way the standards are now is, essentially it would treat those as modifications almost on a prospective basis. But for transition, what this is saying is, all right, you already know what happened in the future. Why not apply logic and kind of pull that together and make sure that the accounting is in the spirit of what that agreement actually looks like after the modifications. So it's certainly a good clarification and just makes sense. So use of the hindsight approach for contracts that were modified multiple times prior to the adoption. So what does it enable you? You determine the transaction price at the date of initial application and perform a single standalone selling price allocation. So back to that original sketch that we had at the beginning when we got that bag of money and we're dividing it up into the to allocate to the actual obligations that our seller has entered into. What this is saying is when you get to the end and you've got all these modifications, take a look at what the total consideration is and do one standalone selling price allocation based on that, and allocate that consideration to the satisfied and unsatisfied performance obligations. So take a look at what that bag of money is after all these modifications and allocate it. And of course, any subsequent modifications to this are going to be accounted for using modification guidance in the new standard. So, you know, in a nutshell, that's all the changes that have taken place in 2015. So I'll open it up to the group if you have any questions for me.
We don't have any in the room, Justin.
All right, great. Thank you, Joe. If anyone does have any questions, you guys can feel free to put them in the questions function on your side panel. We did have a couple that came in, so I'll just start with those. One of the questions was, could you talk about revenue recognition in regards to determining the creditworthiness of the client?
Yeah, sure. So I guess that's more directed to how you would look at revenue recognition or profitability of a prospect that's going through the application.
Yeah, I would believe so.
Yeah, so I mean, essentially with any of this guidance, I mean, the biggest challenge in transitioning is always education. You've got stakeholders who are using the financial statements to make, you know, credit decisions, right? So what does this change mean for the stakeholders? How does it impact your decision to grant credit? And the question is it's probably not determinable, because you probably deal with vendors who are in all different industries, come from different walks, and they haven't analyzed yet what these changes probably mean for their business and what their P&L looks like. And think about all of the discussions they need to have with their stockholders, their other stakeholders, lending institutions, et cetera, and figuring out what do these changes really mean for my loan covenants. You know, people are still in the process of figuring out. And, you know, I'd venture to say that the most significant change is going to be experienced by companies who operate in industries that were guided by specific revenue recognition guidelines. So those are going to be the industries. Software is a specialized industry with specialized revenue recognition rules. Construction, percentage of completion accounting, those types of things I'd venture to say are going to have the most significant changes. But, you know, it's really difficult unless you put pen to paper and figure out what your P&L is going to look like when you adopt this. And, you know, that's one of the great reasons why this was pushed out a year, because people are sitting down and realizing, you know, it takes a significant amount of time and resources to go through this. And, you know, one of the things that we're doing is helping clients try to figure out what is this going to look like. So we do some work from a consulting perspective, not necessarily with our audit clients, but other clients, and, you know, act as their technical advisors to try to help them through the process. I hope that answers a little bit, but, you know, unfortunately, there's not a great answer to what it's going to look like when all of this flushes through.
All right. The next question that we have here is, what would be the biggest piece of advice that you could give, or the biggest takeaway from this presentation?
I would say at your institutions, your companies, start evaluating this now, not necessarily just from, you know, your perspective and how it may impact your particular position and your decisions, but also making sure that the company that you work for and your stakeholders understand what this means. And you got to start planning now. It may get deferred again, but it's going to go through at some point. It's just a little bit uncertain as to when, but planning is key, and really understanding what education is necessary to understand what these changes mean and what actually needs to be done to company systems to prepare them for these changes that are coming. Our system's going to be able to switch over on that adoption date to the new recognition. Most likely, you know, companies are going to need to develop, you know, modified systems and probably run parallel for a little bit to make sure that all the kinks are worked out. That's why it's being delayed. So planning is key. Making sure that you have the resources and the ability to execute internally are also critical. It's a good question.
All right, great. The next question that we have here is a question on varying rebates. The question is, what is the best method to adjust for varying rebates since each customer's obligations are not controlled by the seller?
Yeah, so that's a good question. And when you go back to determining what the contract price is, you know, one of the requirements there is to estimate what those discounts are. So if you have a situation where customers do have varying discounts, there has to be some sort of way to specifically identify if there's significant variances, what those expected discounts are, so that the appropriate consideration can be determined up front. So if it's not a scenario where you can take an average or a blend, I think you have to give a little bit of thought to how you actually either develop a system. Otherwise, it's a pretty manual process to go in and identify what that consideration is, taking into account those discounts up front.
All right, and then we have a follow-up question to that. The question is, when should the revenue be recognized if varying rebates are to be paid 30 to 60 days after based on other obligations?
It would probably be fact-driven, but was the question when should it be recognized?
Yes.
Yeah, you'd have to take an estimate of what those rebates are going to be up front. And the consideration for the contract would need to take into account an estimate of what those rebates are expected to be. And, you know, essentially if the estimate is wrong, you'd have to true up a little bit in the subsequent period when you have better facts.
Okay, great. We have another hypothetical question here. That question is, if a client states FOB destination on purchase order, but is responsible for freight once it leaves the seller's warehouse, should the revenue be recognized once the product ships or arrives at the destination?
So it's FOB destination. So your obligations and the risk and rewards of ownership actually transfer when it arrives at your customer. So I would say that recognition occurs upon delivery, not upon shipment.
All right, great. I'm not seeing any other questions here. I'll just leave this open for a few more minutes in case anyone does have any questions. In the meantime, I would like to again remind everyone that we will have the survey that will pop up as you exit the webinar. It really only takes about 30 seconds to fill out, but as I said, it gives us, you know, a lot of great information on how we can continue to improve our webinars for you.
Justin, we have one question in the room here.
Sure.
And just to go back to the issue of collectability, when determining the probability of getting paid, is there any kind of parameters you can provide? Is it based on, say, maybe a set percentage of that receivable that is determined by credit professionals per se?
Yeah, you know, I would say that's probably a good basis for determining, using some sort of historical, and you'd probably want to do it on a customer by customer basis, not necessarily just spreading it over the entire bucket. And, you know, of course, I guess the consideration there is that if you have consistent problems, is it a bigger issue as opposed to revenue recognition?
Okay. Thank you.
All right, I'm not seeing any more questions on the web here, so with that, I'd like to thank Joseph and EisnerAmper for taking the time out to present to our group today. And I'd like to thank everyone, both in the room and on the phone, for joining us for today's webinar. With that, I'm going to close down our presentation. Thank you once again, everyone, and hope everyone has a great rest of their day.
Okay.